are in listen-only mode.
Good afternoon, my name is Jeanette Camping, Conference Manager at Henry Stewart Conference Studies. I'd like to welcome you to this latest in our series of continuing education webinars with today's topic, Real Estate Joint Ventures. We're delighted so many of you could join us today with over 200 property professionals registered for the webinar. At the end of the presentation, we will take questions, so please feel free to send them through via the chat bar, and our presenters will answer as many as possible in the time available. After today's session, you will receive a link to the recording of the webinar. It's my great pleasure to welcome our presenters, Ronald Graham, Neil McKnight, and Rodney Dukes from Taylor Wessing. Thank you for joining us today, Ronald.
Thank you. Good afternoon and welcome to the Henry Stewart webinar on UK real estate joint ventures. I'm Ronald Graham, a partner at Taylor Wessing and the head of corporate real estate. I frequently advise clients on how to acquire and hold real estate assets. I obviously work very closely with my real estate, tax and finance colleagues. I'll let my other two colleagues introduce themselves. Neil.
Good afternoon. I'm Neil McKnight, a Senior Associate in the Tax and Incentives Group at Taylor Wessing, and I advise on a full range of real estate tax matters, including acquisitions, disposals and the structuring of investments.
And I'm Rodney Dukes, Head of Finance at Taylor Wessing, advising on a variety of things in relation to real estate finance, in particular on the sponsor borrower in addition to the lender side.
Thank you. There's a summary of who we are at the team, more information available on the website. Today we're looking at UK real estate joint ventures and considering the different options as to how you structure them, the tax implications of those different options and how you would look to finance them. Given the short time available, this will be in general a relatively high level overview, but with an opportunity for questions at the end and obviously further follow-up if we have time. A joint venture is defined as a business agreement in which the parties agree to develop for a finite time a new entity and new assets by contributing equity. They exercise control over the enterprise and consequently share revenues, expenses and assets. As we will see, some of the regularly used real estate joint venture structures push that definition, given that some parties do not contribute equity and some do not exercise any degree of control over the enterprise at all. I think it's useful just to have a brief market introduction in terms of how things currently stand in the UK. The last 12 months, as most of you will know, have continued to see a very high level of activity in the commercial real estate market, with overseas investors continuing to dominate. The acquisition of the Gherkin for an overseas investor, on which Taylor Wessing acted, was typical of well-let commercial buildings being sold at premium prices. Given the shortage of supply of available prime stock, quality assets continue to attract a very high price. The UK market, particularly London and increasingly key cities such as Manchester, Birmingham, Edinburgh and Glasgow, are attracting individuals, funds and corporates who consider the UK real estate a secure investment likely to continue to enjoy good overall capital increase with a strong rental yield. If the tenant is regarded as a blue chip tenant, that will make the rental covenant relatively secure and more attractive, and the building, if it's newly developed and refurbished, will be particularly attractive to overseas investors who do want the inconvenience and can often be inexperienced at development work, so you will usually see increased interest in that asset from the Middle East and Asia. In terms of returns, the highly regarded All Property IPD UK Property Index saw total returns of 20% for the 12-month period to the end of September 2014. The main premium priced interest continues to be in well-let commercial buildings, but high-level retail and development properties, particularly where there's an opportunity for change of use, are now attracting increased interest. The ownership structure of the asset will determine how it's financed, and so it can be beneficial if careful consideration can be given of this up front. Likewise, tax, which is usually the single biggest consideration and the most common reason why a deal will be aborted, should be considered from the outset. Neil will talk in a minute about the tax implications of the different structures, but it's the specific tax requirements of the owners or purchasers that will determine the overall corporate structure and indeed the financing options that are available to that structure. In short, the message here is clear. It's to involve tax experts from as early as possible in the process. The three main joint venture structures that we'll look at briefly today are companies, partnerships, and trusts. Before leaping into it, a preferred joint venture structure, do consider who the parties are, where they're tax resident, what are their existing structures behind the entity that will enter into the joint venture, what are their long-term goals with the investment, is it a long-term investment or a short-term return thereafter, are the underlying assets more suited to redevelopment, how and who will finance the assets purchase and any development costs involved, and will or could there be a change of use from, say, commercial to residential use, which could then impact on the tax status and treatment of the underlying asset. And indeed, is this likely to be a single asset structure, or will further assets be added to it in time? These may seem very obvious questions, but they are incredibly important and directly relevant to how the asset should be structured. Let's turn to the first of the options, company structures. Legal entities, be they companies or individuals, can obviously own property individually or jointly. But this is an inflexible, inefficient structure which we wouldn't recommend. For a joint venture where one or more entities are owning a holding company, one of the simplest structures is for a simple private limited company, a JV co, as we'll call it, to be set up to own the property title, and for the joint venture partners to be direct or indirect shareholders in the joint venture. Indirect is often preferred as this will enable anonymity to be preserved. The JV co will have its own legal personality, so is able to contract in its own name and enter into contracts directly, such as those to finance the underlying assets. The liability of the owners is limited to their share capital in the company and also to any shareholder loans that they may have made to the company. The relationship between the shareholders can be easily governed by a shareholder agreement and is relatively easy for shareholders to transfer ownership. You should note here that any articles of association will be public documents, so will be available to the general public. The company and asset can be governed by directors who obviously have certain statutory duties but will be able to control the underlying asset. The JV co could be a UK company or an offshore entity, the choice largely being dependent upon the tax residency of the shareholders concerned. If they're all UK tax resident, then it's probably unnecessary to have a Jersey or Guernsey joint venture company, although there are some other advantages to that. In summary, a simple joint venture company is a very flexible structure which is low cost to incorporate and administer, but which does have several drawbacks, the most obvious of which is tax. But the joint venture company will also be required to file annual accounts and returns, and this information will be publicly available. Let's now turn to the first of the partnership structures, limited partnerships. There are three main types of partnership. The first is a general partnership where partners have unlimited liability, and for obvious reasons this is undesirable and we will not consider it in this presentation. With a limited partnership, one or more limited partners with limited liability and a general partner with unlimited liability will form the structure. Provided that the limited partner is not actively involved in the management and control of the limited partnership, his limited liability status will be preserved. This can mean that the LP structure is not ideally suited to investors who are going to be actively involved in the management of the property. So were the underlying properties to be development properties where the limited partners were going to get involved, then there would be a risk of that limited liability status being removed. The tax structure here is transparent. As you can see, the income flows directly from the properties up to the limited partners, and indeed any gains would also flow directly up to the limited partners. This is worth considering further, though. If the limited partnership holds an underlying property, then income tax in the UK will still need to be accounted for, and if the LP does not do this itself or have an underlying holdco, then the individual limited partners would be required to file an income tax return, which may be undesirable if they're 100% offshore and don't really want any involvement with UK tax authorities. The LP structure is also one of the most private options for a property joint venture, as there's no annual filing requirements or obligations to file accounts, such as there would be with, as you'll see in a second, with the limited liability partnerships. Also, the limited partnership agreement is a private document, unlike, say, articles of association. In short, the limited partnership is a familiar structure for investors who are not active in the property's management, particularly where the intention is to be long-term holders with infrequent changes of investors in the structures. It's also widely regarded as being tax efficient, which I'm sure Neil will touch on later in this presentation. Let's now turn to, that's a summary of the limited partnership benefits. Let's now turn to the second option, which is limited liability partnerships. So just looking briefly at the structure there, again you've got limited partners. You don't have a general partner requirement here. The limited partners can hold the limited liability partnership directly, which will then hold the property underneath it. The LLP, as I'll call it, is a similar structure to that of the limited partnership in some ways, but with some very important differences. Indeed, the LLP is really more like a corporate entity. It has legal personality, so it can contract in its own name. It has to file an annual return and annual accounts, and there are limited liability protection for partners or members, as there would be with shareholders having limited liability in the company. Members' interests in the LLP can also be structured to provide for different rights accruing to different members. However, they are tax transparent like a partnership, which makes them useful vehicles for investors who are offshore, often in different tax jurisdictions. I'll leave Neil to address the tax considerations of the LLP directly in his review of partnership and the tax implications for joint venture structures. In terms of structuring, there's no need for a general partner, as I indicated, and there's no prohibition on members of the LLP from being actively involved. Indeed, the reverse is true, as members are expected within an LLP to contribute effort and skill to the partnership. As with the LLP and the LLP, it's not an ideal vehicle for frequent changes of members, and this is where partnerships in general, for all their benefits, are ultimately not quite as useful as a company in which shares can be issued and easily transferred. I'm now going to turn to trusts, finally, and in this section there are two trusts, the Jersey Property Unit Trust and the Real Estate Investment Trust. So let's look first at the Jersey Property Unit Trust, or JPUT as they're known. The structure on the diagram shows one where ultimately there's a limited partnership involved. That isn't essential, but you can see you have the property at the foot of the diagram, that the held by trustees which issue units, and the Jersey Unit Trust. In this instance, they're held by a general partner on behalf of the limited partnership. So that's how the limited partners are holding the property in this particular example. Let's talk about Jersey Property Unit Trust briefly. It's a unit trust governed by Jersey law and used to hold real estate. The unit trust itself is not a legal entity. Under a unit trust, legal ownership of the trust assets is vested in a trustee who holds them on trust for the benefit of holders of units in the trust, the unit holders, in accordance with the terms of the trust instrument. JPUTs have been used extensively in recent years as a vehicle to acquire and hold UK property. Historically, the key driver for this was to take advantage of the ceding relief exemption from UK stamp duty, which gave relief from SDLT when property was transferred into a newly formed unit trust. This was abolished back in 2006. However, there are other key advantages of using JPUTs, and those advantages still remain, which make these vehicles attractive for single investors. So briefly, how are these set up? Because people often think that they're going to be complicated, expensive and time-consuming. The first step is to determine who will act as the trustee, and usually this will be professional trustees. This will be a separate manager which will be a party to the trust deed. In Jersey, trust company business is regulated by the financial services law, and persons carrying on trust company law business are subject to certain exceptions required to be registered under the FS law. Professional trustee companies will typically have a registration already in place. However, where the JPUT is to be established as a straightforward property holding structure, it may be preferable for the trustee to be a private company established for this purpose. The unit holder has a greater degree of control over the JPUT because it can populate the board of members where a company is used, and the trustee company can also be sold along with the units in the JPUT when the underlying asset is to be sold. Jersey unit trusts are often known as very private unit trusts where there are less than 15 investors. This is because no offering memorandum is required to be issued. This form of Jersey unit trust requires consent from the Jersey Commission before it can raise money, but such consent is normally a formality, only taking a few days. There's also other advantages of JPUTs. They're tax transparent, which Neil will touch on again. They can be set up in that way so the income will flow directly up to the unit holders. There's no requirement for a Jersey unit trust to be listed, as would be the case with a REIT, and the units are easily transferable. It's similar to a share in the company and transferable in the same way. This contrasts with the partnership interest that we looked at in the previous examples, which is a more complicated process. The statutory framework is very friendly for them and not overly restrictive, making them an attractive option in some structures. And finally, for this section, just to look at REITs, I felt it was relevant here and it would be wrong to ignore them. Available in the UK since 2007, there is a requirement for them to be listed vehicles in order to operate. Generally work where, because property is a relatively illiquid asset, the shares in the REITs themselves, the idea that they can be more freely traded. They don't pay a corporation tax or CGT. There's a requirement on them to distribute 90% of the cash flow as dividends. And as you can see, by 2013, the global market cap for REITs was $790 billion. It's an observation of which most of you will be aware, that they have not proved as popular in the UK as they have, say, in the US, partly because when they were introduced in 2007, it was a difficult time for the market. The setup costs are relatively high. The UK regulatory regime is not as friendly as it could be to setting them up, and generally, as listed assets, they've underperformed the FTSE stocks. So that concludes the corporate structuring part of the seminar. I'll now hand over to Neil McKnight. Thank you.
Thank you, Ronald. So to begin with, this first slide briefly summarises some of the key tax considerations which will be relevant when selecting a JV vehicle. Transfer taxes such as stamp duty, land tax, and from April this year the Scottish Land and Building Transaction Tax, which will replace SDLT in Scotland, and also irrecoverable VAT, can have a significant impact on the commercial viability of any real estate investment or real estate development project, as these tax charges will often be priced into the value that a prospective purchaser will be willing to give for a real estate asset. Just to give an example, stamp duty land tax is chargeable at up to 4% of the VAT inclusive purchase price of commercial or mixed-use real estate assets, with the rates for residential property potentially much higher, which can clearly be a significant cost. So, when structuring a JV, consideration should always be given to minimising these taxes. For example, if the target real estate asset is held in an SPV, consideration could be given as to whether it would be possible for the JV to actually acquire the SPV, as this could lead to a significant tax saving. The consideration given for the shares in a UK company will generally be chargeable to stamp duty at 0.5%, which is a significant saving on the equivalent stamp duty land tax charge, and shares in an offshore entity would generally not be subject to UK stamp duty. This can of course create its own issues because the SPV may have historic liabilities, but this is a well-trodden path and these concerns will often be dealt with by way of indemnity and warranty protections in any acquisition documents. If this path is chosen, then following acquisition of an SPV and depending on the choice of JV entity, it may then be possible to actually extract the asset into a clean SPV or directly into the JV with minimal tax exposure if reliefs such as stamp duty land tax group relief are available, which broadly would eliminate the SDLT charge on an intra-group transfer of a real estate asset. And this planning is also a consideration on disposal of the asset because on an exit and depending on the type of JV structure, it may be actually possible to sell the structure to the purchaser. And if this results in a tax saving for the purchaser, the seller may be able to negotiate an increased price taking this into account. It's also necessary to consider how the JV itself will be taxed and to minimise double taxation at the level of the JV entity on its profits and at the investor level on any distribution of profits. As Ronald has already mentioned, an opaque structure, such as a limited company, will generally be taxpayer in its own right, whereas investors in a transparent structure, such as in a partnership, will generally be taxed on the income and gains of the partnership as they arise. For investment in UK real estate, some of the key considerations here will be how rental income is taxed, and also whether tax will become a cash flow issue for the JV or the investors, because there's a requirement for, say, a tenant paying rent or a borrower paying interest to withhold tax from those payments. And on a disposal of the asset, we'll also need to consider how the JV will be taxed on any gains which may arise, which leads into the next point on the slide, which is how the investors will be taxed on an exit. On the disposal of their own investment in the JV, be that shares in a company, their partnership interest, or on any distribution of profits received from the JV. Finally, anti-avoidance rules are becoming a more acute concern and should always be considered when structuring a JV. In a recent example, the diverted profits tax, which the government is proposing to introduce into this year's Finance Act, could have an impact on many common offshore property development structures which take advantage of certain tax treaties the UK has with other jurisdictions to prevent development profits from falling within the charge to UK tax. So with all this in mind, it would be useful to quickly summarise how UK real estate is taxed. I've already mentioned stamp duty land tax, and this slide sets out a brief overview of the rates. Commercial property is subject to SDLT at a top rate of 4%, where the chargeable consideration for the property exceeds £500,000. This consideration could be cash, but it could also include other items, such as certain construction works and the assumption of debt. For residential property, the SDLT regime has recently changed, moving away from the old slab system, where the entirety of the consideration was charged at one rate, to a progressive system, similar to that we have for income tax, where each slice of consideration is taxed within the rate band. The table on the slide sets the rates out. It is, however, worth pointing out that acquisitions of portfolios of residential property, so that would be 6 or more residential properties, will generally be subject to SDLT at the commercial rates, which can represent a significant saving for investors. However, investors should bear in mind the 15% SDLT charge, which applies when what are termed non-natural persons, so that would be a company, a partnership with one or more corporate members, or a collective investment scheme, acquire single residential dwellings which are worth more than £500,000. There are, however, a number of key exceptions to this, including where the property is acquired for a property rental business or a property development or resale trade which is run on a commercial basis. Acquisitions of UK real estate may also be subject to VAT. Commercial property or bare land is generally exempt from UK VAT, although new build commercial property, so that's property that's less than 3 years old, will always be subject to VAT at the standard rate. A property owner can, however, make what's known as an option to tax in respect of the land or the commercial property and elect to charge VAT on any supplies of that property which it makes. The main reason for doing this will be to ensure that the landowner can recover any VAT that they have themselves incurred on items such as development costs, although it does mean that the landowner will then be required to charge VAT going forward on any supplies of the land, such as on rents and on a sale of the property, unless the transfer of business as a going concern treatment is available. This applies broadly where a property business is sold, so for example a tenanted property or certain construction sites, and it basically means that the sale of the property will be disregarded for VAT purposes, meaning that no VAT will be chargeable. Residential property is generally exempt from VAT, although importantly for property developers, the sale of a freehold new build residential property or the grant of a lease of more than 21 years of a residential property will be subject to VAT at a zero rate, which enables the developer to recover VAT that it's incurred on its development costs. At this stage, it's perhaps worth noting that VAT would not be chargeable on an acquisition of shares in an SPV holding real estate assets, and that's regardless of the VAT status of the underlying asset. For the JV, if VAT is chargeable on the acquisition of real estate, the key consideration is whether the JV can recover that VAT. So is the JV registered for VAT, and does it intend to make taxable supplies in its own right? And also, a question is how the JV will fund the VAT before it can recover it from HMRC as part of the normal quarterly VAT return cycle, or in situations where the JV is recovering more VAT than it's paying over to HMRC, as will probably be the case on a property development project, the JV may be entitled to make monthly VAT returns, shortening the amount of time it takes to recover the VAT. It's also worth remembering that VAT will always be taken into account in determining the amount of SDLT payable, and that's regardless as to whether that VAT is recoverable by the JV. It's also worth pointing out that SDLT and VAT will be payable by a JV, regardless as to where the JV is resident for tax purposes. Turning quickly to investment returns, UK property income, so that's basically rent, will always be subject to UK income tax or corporation tax. In the case of a UK resident individual, income tax will be payable at 20%, 40% or 45%. A UK tax resident company will pay corporation tax, which is currently charged at 21%, but which is being reduced to 20% from April this year. Non-UK tax resident individuals and companies will always pay income tax on UK property income at 20%. The level of taxable profits in the JV may, however, be reduced, commonly by the use of reliefs such as deductions for interest expense, which was incurred on borrowing at the level of the JV or any other entity which holds the real estate asset, and also capital allowances, which are available generally at 18% or 8% of the value of qualifying plant and machinery expenditure, and that depends on the nature of the qualifying plant and machinery asset. The UK does impose a withholding tax on payments of UK property income to non-resident landlords, so in this context offshore JVs, of 20%, and that's on account of UK income tax liabilities. This can have a significant cash flow impact on the JV, but it is possible for the non-resident landlord to obtain clearance from HMRC to receive payments of rent gross and free of withholding. And this is advisable, as the withholding can, as I said, have a significant impact on cash flow. Generally, HMRC do seem to be willing to grant clearance if it can be shown that the non-resident's tax affairs are in good order. Moving to a disposal of UK real estate, UK tax resident individuals will be subject to capital gains tax as a rate of 18 or 28% on any gains arising to them, and UK tax resident companies corporation tax at a rate of 21%, or as I've already said, 20% from April this year. The UK's tax regime is, however, particularly generous in that non-UK tax resident individuals and companies are generally exempt from UK capital gains tax realised on assets held as investments. However, if the person is carrying on a trade in the UK, or in the case of a company it's carrying on a trade through a permanent establishment in the UK, for example, if it acquires the property and is redeveloping the property with an intention to sell the property on at a profit rather than retain it as an investment asset, then the profits of the trade will be subject to UK tax. This is one of the key considerations when structuring a UK real estate investment or development projects. It is worth noting that the UK's tax regime has changed in recent years, specifically in relation to residential property assets. This began with the annual tax on envelope dwellings, or ATED, which imposes an annual charge on non-natural persons. This is the same definition as for the 15% SDLT rate. So that's companies, partnerships with one or more corporate members and collective investment schemes which hold UK residential property valued at more than £2 million, with this threshold reducing to £1 million in April this year and £500,000 from April next year. And as with the 15% SDLT charge, there are exceptions for property letting businesses, property development and resale trades, all of which are undertaken on a commercial basis. For non-natural persons within the 8-head regime, gains on the disposal of residential property will also be subject to capital gains tax, and the government is also proposing to introduce a general charge on non-residents holding UK residential property as part of the Finance Bill 2015. So now turning to an overview of the structures identified by Ronald, beginning first with the example of use of a company as a JV. And in this particular example, it's a limited company which could be offshore or onshore. As Ronald said, this is an opaque structure, which means that the JV is a taxpayer in its own right. So it will be taxed on its income and gains before it makes a distribution of its profits to the JV partners. In determining the tax profile of the JV, one of the key considerations will be whether it should be structured as an onshore or an offshore JV. This will depend on a number of factors, including, as Ronald said, the residence of the investors. And for non-UK resident JV partners, the preference would generally seem to be for an offshore JV company, which I've already mentioned will be subject to SDLT, VAT, and also UK income tax on its rental income, but it should not be subject to UK tax on chargeable gains unless it's carrying on a trade in the UK through a permanent establishment, an example being through a construction site. For a non-resident company, it's critical to ensure that central management and control, so that's basically board-level decisions, are not exercised in the UK, to ensure that the company does not become resident in the UK for tax purposes. So what's this structure used for? It's suitable for investment, particularly when the JV is resident in a low-tax or no-tax jurisdiction, such as one of the Channel Islands. However, the offshore corporate JV structure is often used for property development activities in the UK, particularly where the JV is incorporated and tax resident in a jurisdiction which has a favourable tax treaty with the UK. Under UK domestic law, and also under many of the UK's tax treaties which follow the OECD model, a construction site can constitute a permanent establishment, which can potentially bring the profits of UK property development within the charge to UK tax. However, the UK's tax treaties with jurisdictions such as the Isle of Man, and also with some of the Channel Islands, do not make reference to a construction site constituting a permanent establishment, which means that the profits of that venture should not generally be subject to UK tax. However, the continuing efficacy of this structure should be kept under review, particularly in light of the proposed diverted profits tax I mentioned earlier, which aims to challenge the use of tax treaties to avoid permanent establishments in the UK. As this structure is opaque, it's also necessary to consider how the JV partners will extract their profits. In the case of a company, this will be by way of a dividend, which may or may not be subject to withholding tax depending on the jurisdiction in which the JV is established. However, the JV partners may want to consider a direct sale of shares in the JV company, which may result in the stamp duty land tax saving mentioned earlier for the buyer. And if the JV is an offshore company, no UK stamp duty should be payable, which could potentially be priced into the deal. Turning to Ronald's second example, a partnership JV, the example shown on the slide is a limited partnership, although in general terms the tax treatment of a general partnership or a limited liability partnership should be broadly the same. As Ronald said, the partnership is generally a transparent structure, and this means that tax on the investment return and also on any gain will arise directly to the investor. Structurally, this eliminates potential double taxation at the level of the JV, although it can create issues for certain JV partners who may not wish to file a UK tax return. The partnership is, however, taxable for VAT and SDLT purposes, and as regards SDLT, certain specific rules apply here, where JV partners are contributing real estate assets to the JV. The effect of these rules broadly is that a JV will be subject to SDLT based on the proportion of the value of the real estate asset the partner is treated as transferring to the other partners, and that will be calculated in accordance with the partners' income sharing ratios. For example, in a 50-50 JV, a partner would effectively be treated as transferring 50% of the market value of the real estate asset to the other partners. On an exit, it's worth noting that a partnership will generally sell the underlying assets, so consideration may need to be given to holding real estate assets in SPVs, such as offshore companies, which, as I already mentioned, may permit the sale of shares in an SPV to give a stamp duty land tax saving. The final class of structure Ronald identified, the trust, is represented here by the offshore unit trust. In the UK commercial real estate market, as Ronald has already mentioned, this is most commonly a Jersey Property Unit Trust or a JPUT. The offshore unit trust structure is generally semi-transparent if it's constituted as what's known as a Baker Trust, which means that the income of the trust arises directly to the unit holders as it arises, and so it's the unit holders and not the trust who will be subject to UK tax on that income. However, for capital gains tax purposes, or corporation tax on chargeable gains, a unit trust scheme, which is a collective investment scheme within the meaning of Section 235 of the Financial Services and Markets Act, will be treated as a company and so will be opaque for the purposes of UK tax on chargeable gains. Broadly, to qualify as a collective investment scheme, the unit trust must have more than one unit holder, and the unit holders must not participate in the management of the unit trust on a day-to-day basis. As the unit trust would be treated as a company in this situation, if the trustees are non-UK residents, then any investment gains at the level of the trust should generally be outside the charge to UK tax. And for these purposes, the trust should be non-resident if it has non-UK resident trustees and its affairs are managed outside of the UK. The company treatment also extends to stamp duty land tax, which means that a sale of the units in a unit trust should not be subject to SDLT if the register of should not be subject to stamp duty if the register of unit holders is held and if the register of unit holders is held outside the UK, no stamp duty. So before I hand over to Rodney, who will discuss financing the JV, this final slide sets out some of the tax considerations which may be relevant to financing arrangements. The most common tax consideration will be whether the JV is required to withhold tax from payments of interest it makes to its lenders. Withholding tax at 20% is levied by the UK on payments of UK source yearly interest. An interest will generally have a UK source if, for example, it's paid under an obligation governed by English or Scottish law, which is enforceable in the UK, although other factors such as the source of funds used to pay the interest and security arrangements may also be relevant. There are a number of exceptions to the requirement to withhold, so for example if the payment is made to a UK corporation taxpayer or to a UK bank. And in relation to non-UK lenders, relief may also be available under a double taxation treaty, although this does involve making a claim to the relevant tax authorities, which can be time-consuming. However, the UK has introduced the double taxation treaty passport scheme to expedite this process, which is available to corporate borrowers and which allows lenders to passport loans and bypass many of the timing issues. Withholding tax can become more complicated, though, where payments are received by a transparent structure. So, for example, if a limited partnership lends money to SPVs, it's necessary to consider the jurisdiction of residence of the members of the partnership who are entitled to the interest in order to determine the relevant double taxation treaty and whether relief would be available from withholding tax. And finally, transfer pricing should always be a concern for JVs who are debt financed by the JV partners, as the UK and many other jurisdictions restrict the availability of interest deductions in entities which have excessive gearing or are borrowing at excessive rates of interest. I'll now hand over to Rodney.
Good afternoon, everybody. Thank you, Neil, Ronnie. I'm going to take you through some high-level points to consider when third-party debt is introduced to any of these structures. In the time allotted, this can only really be a high-level review. And the initial point I think I want to make today is that in spending time and probably quite a lot of money in locating the relevant asset, crafting a structure, determining jurisdiction of main operations for tax efficiency at the asset and at the investor levels, If third-party debt is to be introduced into the structure, then the joint venturers, the investors, need to understand the likely lender requirements and the effect that those requirements will have on costs and cash flow. Joint venture investor parties need to carefully consider and craft their structure to suit themselves, but also have regard to the likely requirements of the lender. The second point I'd like to make in general terms is that lenders come in all shapes and sizes. Some of you may have heard our webinar we did with Henry Stewart on non-bank lenders. Supply of debt currently is plentiful from banks, insurers, debt funds, in addition to sources like crowdfunding. Whilst variances will exist in requirements, all lenders will be looking for not only a return on their loan, their investment, but also to be able to monitor operations, to ensure cash flow is managed through day-to-day operations prior to a return being provided back to the joint venture investors, and to be able to step into the structure in the event of problems, and ultimately to be able to enforce and take control of the asset in order to preserve value and sell, or to develop and sell the asset in an orderly fashion to get their money back. Looking at this slide, Ronnie took you through the various structures on this slide, and the legal structure of the entity will determine the overall finance package. By finance package, we mean the loan agreement and security documentation. That documentation may be lender standard form, short, wide-ranging, and used certainly for deals, say, below 5 million. In higher value transactions, documentation will more likely follow Loan Market Association standard documents, with particular requirements drafted to suit particular lenders. So whilst the structure, asset location, jurisdiction of main operation of the entity and investor requirements are key, the introduction of third-party debt will impose a structure, and as a consequence, a discipline to the structure and operations. Each of these types of legal entity will be acceptable to lenders, but rigidity of requirements of lenders may mean higher costs and inflexibility for joint venture investors. The key in real estate finance from a lender joint venture point of view is to look to hold the asset in a special purpose structure to avoid complication of other lenders and assets. Once other lenders and assets outside of those being directly funded are required to be managed through the documentation, necessarily costs rise and lender involvement will rise. In addition here, we do not really consider the provision of mezzanine lending in these structures, as this would take up another seminar in itself. We have not mentioned the unincorporated ventures so far, the one at the bottom of the slide there, and that's because it gives rise to too many complications to lenders, as you can see from the note. Just turning to the simple structure on slide 2, this shows the joint venturers each owning a part of a selected joint venture entity. The entity then owns an asset or series of assets to be funded. The loan facility is made available to the joint venture entity, and that entity provides security back to the lender. Whilst the lender will look to ensure to take a full package of security from the asset-owning entity, whether the joint venture investors, sponsors have to provide direct security to the lenders will be determined by the lender's view and the negotiation skills of the joint venturers of the risk and return to the lender. Guarantees may be required, or even security to support a higher level of loan, or the lender's view of risk and return. However, this removes from a joint venturer's perspective a key reason for the structure in the first place, namely the bankruptcy remote nature of the entity, away from the joint venturers. We look at the security package itself in a later slide. I flick quickly onto the third slide, which is the more complex joint venture structure. This envisages each joint venture investor sponsor providing their investment through a holding company to a special purpose vehicle which itself owns the joint venture entity. The joint venture entity then owns the assets underneath. The lender here is funding to each of the joint venture's special purpose vehicles, with funds then being on-lent to the joint venture entity which itself owns the asset or series of assets. Security here being provided not only from the joint venture entity itself, but also from each of the joint ventures' special purpose vehicles. In addition, security is being provided over the holdco's interest in their special purpose vehicle. Again, the question of whether the investor's sponsors will be required to provide guarantees or direct security will be determined and negotiated on the basis of risk and reward for the lender. In the first structure, it was easy to see the way in which all the parties will identify the limits of a security package, with the aim of the lender to ring-fence the asset to the joint venture entity. Security may be limited only to a charge by way of legal mortgage over the asset itself. Such a mortgage will contain other provisions to ensure capture of income arising and insurance proceeds. More likely, too, will be a requirement to have security over the vehicle itself by way of floating charge if available, and the interests of the investor sponsors in the joint venture entity, the shares, the membership rights, the units, depending on which entity is selected. The joint venture investor sponsors may have provided their equity through pure equity, shares, or through loan capital. Lenders, depending again on risk, reward, size of loan, sophistication, will look to ensuring control is able to be obtained over that entity through share security and subordination of any loan, i.e. that no repayment of any such loan can be made until the lender's debt has been repaid in full. Normally also the lender will also look to assign any such loan, so that in insolvency of the joint venture, investor sponsor itself, the lender can take control of any such loan. Clearly, carve-outs to allow return to be made to the investors of capital and income can be negotiated, again depending on the risk profile of the loan. Cash flow will be monitored and in more sophisticated transactions controlled. The lender will want to ensure the ranking of claims to income, effectively to ensure that day-to-day operational expenses are met, as well as interest under the loan, prior to the joint venturers obtaining any income arising. Management fees are often sought by joint venturers, notably through captive asset management entities, and lenders are wise to these structures. Lenders will look to asset managers, managing agents, for duties of care, for approval of fees, as well as the ranking of any claim. The security to be taken from the joint venture vehicle itself will be very full. Essentially, the lender will wish to extend its rights to all assets or the entity, both present and future. Physical assets, as including rent and other accounts, any offtake agreements and sale proceeds. Where the type of entity allows, a floating charge will be taken to provide the lender with an additional element of control, opening the possibility for administration under English law as opposed to an LPA receivership. As I've mentioned, a lender will likely want to have the ability to control the asset-owning entity itself, and not just the asset in the event of enforcement. The ability to sell the entity itself allows for SDLT saving, as Neil mentioned earlier, by a purchaser, although of course the purchaser will be buying the entity with any existing or potential liabilities. It has become standard practice for security to be granted over the shares of a limited liability entity or the membership rights for an LLP or partnership rights for an LP. Where contractual rights exist in relation to matters like the ability to call for additional cash from the sponsors, or preemption rights exist, or distribution rights exist, the lender will want to ensure that these marry into the finance documents to allow the lender all the remedies that it wishes to have and the flexibility of approach it desires. Ultimately, as mentioned, there may be a requirement for a sponsor guarantee. The next couple of slides identify some complication factors to bear in mind. In particular, it's been mentioned already that the GP is liable without limit. Individual limited partner loans may be regulated by the Consumer Credit Acts. In addition, the JV entity of the sponsor, where the JV entity of the sponsor is within the scope of the Alternative Investment Fund Managers Directive, AIFMD, essentially where the sponsor of the entity is a fund, the legislation there may be relevant, so some care needs to be taken. In relation to unit trusts, there's the separation of, it's on the next slide there, the separation of unit trusts, the separation of legal and beneficial title of the assets. Care here needs to be taken in relation to the removal and retirement of trustees and on replacement on sale or substitution of the underlying asset. And just flicking back to the previous slide, again there's some information there on unincorporated JVs and notably from a lender perspective, the inability to get a qualifying floating charge. Finally, just to mention in relation to overseas entities, there will be a need to consider different security requirements and enforcement procedures. The relevant centre of main interest, the COMI, is an important consideration for all parties in determining an applicable insolvency regime. Last but by no means least, in relation to overseas entities, legal opinions will be required on capacity and enforceability. I think that concludes really the very high-level review of a lender perspective, and I think we probably have some time for some questions. Turning now to my colleagues.
Yeah, thank you, Rodney. We've had a flurry of questions in during the presentation. We won't be able to deal with all of them, but we could turn to perhaps the first one that came in, probably more aimed at you, Rodney. Do you think a lender is happier providing finance to a typical joint venture entity as opposed to the parties involved in an alternative structure? It's almost the subject of a separate presentation in itself, but any thoughts on that?
Yeah, I think the sort of structures we've been looking at are fairly typical, in particular in relation to the where you simply have a limited company or LLP, or indeed the JPUT. That is something which most lenders, certainly in the London market, would be familiar with. In relation to alternative structures, I suppose my reference point there would immediately come to thinking about some of the Sharia structures that we set up, and certainly those add a level of sophistication and complication, which means that some lenders cannot get comfortable. As soon as one starts to separate the legal and beneficial title to assets, whether at the share level or the asset level in terms of legal and beneficial interest, lenders do tend to get nervous, and so consequently discussions around taking security over units in a JPUT or taking security from trustees in a JPUT usually adds some spice to the negotiations. In a typical Sharia structure, then the separation of entities who with conventional banks are entitled to pay interest, and the Sharia compliant side of a structure where interest is clearly not allowed to be paid, then again that separation causes some lenders some issues. So yeah, I guess the answer to the question in short is yeah, they're happier providing finance to a typical joint venture, and I'll stop waffling.
No, that's very interesting, thank you. It's probably just time for one more that's also just come in terms of, and the question is, do you typically see joint ventures forming across international borders, or do they tend to be domestic entities joining forces? I'll take this one unless anyone else wants to dive in. Generally, from a sort of corporate perspective, we do see joint ventures forming across international borders and tend to being offshore rather than sort of domestic entities. Most of the investors that we're seeing are offshore, or even if they're active onshore, then they have offshore entities that will generally be the parties that are entering into this. So yes, I mean, right at the start I referred to the number of international parties and the interest from Asia, from the Middle East in the UK market. So it's very much an international area that we're seeing, and certainly the joint ventures are, you know, more of an international flavour to them rather than domestic. Yeah, on that one. Right, I think that probably wraps us up for this afternoon. Thank you very much all for listening. There's a slide which I think is up on your screen now about the next upcoming webinar, high-end residential real estate, which I heartily recommend. So thank you all very much. Good afternoon.